A market bottom is not a singular event. It is an environment, a psychological battlefield where fear, despair, and capitulation dominate every decision. It represents the point of maximum financial pain for the majority of market participants. To the average investor, it feels like the world is ending. Prices have collapsed, portfolios are bleeding, and confidence has evaporated. Every small rally is quickly crushed. Every piece of news is interpreted as confirmation that things can only get worse. But for the professional speculator, this landscape of despair holds a very different meaning. He understands that the very emotions driving the crowd to liquidate their holdings in panic are the same forces that create the opportunity of a lifetime. In the words of Richard D. Wyckoff, one of Wall Street's greatest market theorists, the time to buy is when the public is most frightened. The professional knows that the market bottom is not a precise point in time. It is a process. This process unfolds logically in distinct phases and is governed by the law of supply and demand. When supply, the willingness to sell, finally becomes exhausted, and demand, the willingness to buy, begins to quietly emerge, a new market cycle is born. Wyckoff called this process accumulation, the hidden phase where strong, informed interests quietly absorb stock from a demoralized public. To truly understand this process, we must introduce the central figure in Wyckoff's methodology, the composite operator. This is not a single individual, but a conceptual representation of the largest and most skillful market participants. Institutional investors, professional syndicates, and highly capitalized traders who possess the resources and patience to operate strategically. The composite operator's goal is not to trade randomly. He builds campaigns. He buys when others are selling and sells when others are greedy. His activity leaves distinct footprints on the price and volume chart, footprints that the trained analyst can learn to read. When a bear market is in full force, the composite operator does not fight against the prevailing downtrend. Instead, he waits. He allows the panic to run its course. But when prices reach levels that are irresistibly cheap, when fear has reached its climax and the public can no longer endure the pain, he begins to act. Quietly, methodically, and without drawing attention, he begins to accumulate. This process of accumulation unfolds through a sequence of logical and observable events. Wyckoff identified 5 definitive proofs, 5 categories of evidence, that reveal when the composite operator is actively positioning for the next bull market. Each of these proofs can be seen on the chart by any trained eye. They are not guesses, not predictions, but scientific observations of market behavior. Before we explore them, we must appreciate the mindset that allows the professional to recognize these signals. Where the public sees chaos, the professional sees structure. Where the public feels fear, he feels opportunity. The crowd trades on emotion. The professional trades on evidence. The first proof of a market bottom is what Wyckoff called stopping action, the point where the relentless downtrend finally meets professional demand strong enough to halt its decline. This does not mean the market immediately reverses upward. Instead, it enters a process of stabilization as the imbalance between supply and demand begins to shift. The second proof is the phase of absorption. This occurs when the composite operator, having halted the decline, begins the slow and patient work of absorbing the remaining supply from weak holders. This is the long, often boring trading range that frustrates traders and shakes out those who lack conviction. The third proof is the final shakeout, a deliberate move designed to deceive and exhaust any remaining sellers. The market briefly dips below support, triggering stop losses and convincing late sellers that the downtrend has resumed. But instead of following through, the price quickly rebounds. This is the final test confirming that supply has been completely absorbed. The fourth proof is the show of intent, the moment when professional demand asserts itself openly through a strong, decisive rally out of the accumulation range. This is Wyckoff's sign of strength, the first true declaration that the market's character has changed. Finally, the fifth proof is the confirmation, known as the last point of support. After the initial rally, the market pulls back lightly to test its new support level. If volume remains low and selling pressure weak, the professional knows the risk is minimal and a new bull phase is beginning. Understanding these 5 proofs transforms market analysis from speculation into a disciplined science. The professional does not guess where the bottom is. He identifies it through evidence. In the sessions that follow, we will dissect each of these 5 proofs in detail. We will learn to recognize their signatures on a chart and to understand the psychological dynamics that produce them. Because once you can read the market's internal anatomy, you are no longer part of the fearful crowd. You are aligned with the composite operator himself. This is not merely about finding the low. It is about understanding why the low forms, who creates it, and how to recognize it with the clarity and confidence of a professional. Every major market bottom begins not with optimism, but with exhaustion. The public, having endured months or even years of relentless decline, finally reaches a breaking point. Prices have fallen so far for so long that despair becomes the dominant emotion. Hope turns into fear, and fear into capitulation. This emotional collapse creates the conditions for the first definitive proof of a market bottom: the stopping action. Wyckoff taught that a powerful downtrend cannot simply reverse by chance. Momentum, once established, must be stopped by an opposing force of equal or greater strength. That opposing force is professional demand, the quiet but decisive intervention of the composite operator. When this demand first enters the market, it leaves behind unmistakable traces on the chart. The earliest sign of this intervention is called preliminary support, PS. After a long and punishing decline, a trading period suddenly appears that looks dramatically different from what came before it. The price spread widens sharply, the volume surges, and although prices may continue to fall, something has clearly changed in the character of the action. This increase in both price range and volume is the first footprint of the professional buyer. What is actually happening here? The composite operator has begun to test the market's depth of selling pressure. He is not yet attempting to reverse the trend. Rather, he is probing. His goal is to see how much supply remains. He knows that the public still holds stock and that fear is at its peak, so he absorbs only what he can without driving prices too far upward. This act of controlled demand creates a visible slowdown in the rate of decline. The next, and far more dramatic event in the stopping process, is the selling climax, SC. This is the emotional and psychological crescendo of the bear market. It is the moment when the average investor, having endured unbearable losses, finally surrenders. All restraint vanishes. People are no longer thinking rationally. They are reacting to pain. The collective decision becomes simple: get me out at any price. This wave of panic produces an extraordinary expansion in both price spread and trading volume. Prices collapse violently to new lows, often in a single session or over a brief cluster of days. The tape records chaos. The untrained eye sees only destruction. But the professional sees something else entirely: a transfer of ownership. For every share sold in fear, someone must be buying in confidence. The enormous volume at the selling climax is not random noise. It is the historical record of this great exchange. It reveals that the public, in its panic, is handing over ownership to the strongest hands in the market. The key evidence confirming a true selling climax lies in the close of the bar. Even though the price may plunge to new lows intraday, a genuine selling climax bar will often close well above those lows. This means that powerful buying came in near the end of the session, absorbing the flood of panic selling and driving prices back upward. That recovery off the bottom is the signature of professional demand overwhelming public supply. To the untrained observer, it looks like a simple bounce, a random event in a sea of chaos. But the Wyckoff analyst knows better. He recognizes that this recovery, combined with record-breaking volume, is the market's first declaration that the old trend has been stopped. The imbalance of supply and demand that drove prices lower has now been neutralized. After this dramatic climax, the market does not immediately begin to rise. Instead, it often enters a brief but important automatic rally, AR, a natural rebound caused by the sudden absence of selling pressure. With the majority of weak holders now out, even a modest amount of demand can lift prices rapidly. This rally marks the beginning of the trading range that will later define the accumulation phase. Once the automatic rally concludes, prices usually drift back down again in what Wyckoff called a secondary test, ST. This is where the professional analyst must pay careful attention. If the secondary test returns to the area of the selling climax but does so on lower volume and narrower spreads, It confirms that the selling pressure has truly been exhausted. The market has passed its first test. At this stage, the professional does not yet buy aggressively. He simply observes. He knows that the stopping action has laid the foundation for a potential bottom, but that more evidence is still required. He now waits for proof that the composite operator is not only halting the decline, but beginning to absorb supply. The second phase in the process of accumulation. The stopping action is therefore the turning of the tide. It is the invisible hand of professional demand asserting itself for the first time after a long and devastating bear market. It transforms chaos into structure and fear into opportunity. In summary, preliminary support signals the first intervention of demand. The selling climax marks the emotional and structural end of the downtrend. The automatic rally defines the new range of equilibrium. The secondary test confirms the exhaustion of supply. These four elements together form the first definitive proof that the market's character has changed. The professional speculator, studying these footprints, knows that the worst may be over, but he also knows that patience is required. The next phase, the absorption phase, will determine whether this halt was temporary or the beginning of a major new bull market. After the violence and exhaustion of the selling climax has finally halted the decline, the market does not immediately spring back to life. Instead, it enters a long, deliberate period of absorption, the quiet and patient work of accumulation. This is where the professional speculator distinguishes himself from the crowd, because while the public loses interest and turns away, the composite operator is silently preparing for the next great bull market. Wyckoff described this stage as Phase B of the accumulation process, the building of the cause that will later produce the effect of a powerful uptrend. According to the law of cause and effect, the larger and more complete the base that is built during accumulation, the greater the potential magnitude of the following advance. The professional understands that this period of apparent inactivity is not wasted time. It is the essential groundwork for future profits. The purpose of the absorption phase is straightforward. The composite operator seeks to absorb the remaining supply of stock available in the market without causing a premature rally that would alert the public. Every share that is quietly transferred from weak, fearful hands into strong, informed ones brings the market one step closer to a new uptrend. Visually, this process manifests on the chart as a trading range, a horizontal zone bounded by support and resistance. Prices oscillate between these two boundaries for weeks or even months, creating the illusion of stagnation. To the average investor, this is a dead market, a frustrating and directionless zone that seems to punish both buyers and sellers. But to the trained Wyckoff analyst, this sideways movement is a symptom of intelligent activity. Let us dissect the anatomy of this phase. Each rally toward the upper boundary of the range represents a test by the composite operator. He allows prices to drift upward, not because he wants them to rise, but to see how much selling pressure remains. If, as the price approaches resistance, volume expands sharply and the rally stalls, he knows that there is still a significant amount of supply in the market. In response, he may even sell small portions of his own holdings to reinforce the ceiling and prevent an early breakout. This apparent weakness is not incompetence, it is strategy. By keeping the market contained, he prevents excitement from returning and ensures that sellers remain complacent. When prices decline back toward the lower boundary of the range, the composite operator reverses his role. He now steps in as a buyer on weakness, absorbing whatever stock the discouraged public offers. Each dip toward support is an opportunity to accumulate at a discount. In this way, he gradually transfers ownership from weak hands to strong hands, creating the structural base from which a major rally can later launch. The professional analyst monitoring this process focuses on two critical indicators: volume and price spread during tests of support. Diminishing volume on declines. Each successive reaction toward support should occur on lower volume than the previous one. This shows that the supply of stock available for sale is drying up. Fewer sellers remain willing to part with their shares at these low levels. Narrowing price spreads. As volume contracts, the downward price swings should also become narrower and less volatile. This indicates that the remaining sellers are weak and disorganized, and that the downward momentum has been largely neutralized. When these two signs appear together, diminishing volume and narrowing spreads near support, They provide conclusive evidence that the Composite Operator S absorption campaign is succeeding. The stock is being quietly prepared for a future markup phase. During this period, public sentiment remains negative. The media continues to emphasize economic pessimism, and the average trader, scarred by previous losses, avoids the market entirely. Ironically, this lack of enthusiasm is exactly what the professionals need. The best accumulations are built in silence, under the cover of boredom and disinterest. As Wyckoff wrote, "A market that refuses to rally when good news appears and refuses to fall on bad news is quietly being prepared for a major move." Eventually, as the process of absorption nears completion, the market's reactions to negative events become increasingly muted. Downward tests fail to make new lows, and rallies begin to occur with slightly greater ease. The Composite Operator is now testing the market one final time. Is the supply truly exhausted? He will not commit his full resources until he is certain that any significant wave of selling pressure has vanished. This moment of truth leads directly to the next phase, the decisive test, also known as the final shakeout or spring. Before initiating the uptrend, the Composite Operator deliberately creates one last moment of fear to ensure that no hidden supply remains. But the success of that test depends entirely on the groundwork laid during the absorption phase. In summary, the absorption phase is the silent battlefield of accumulation. It is where the Composite Operator conducts his campaign with patience and precision, buying on weakness, selling on strength, and carefully studying the market's reactions. To the untrained eye, nothing seems to happen here. To the professional, everything is happening. This is the second definitive proof that a market bottom is in formation. The proof that supply is being absorbed by strong, informed interests in preparation for a major new uptrend. As the long and deliberate absorption phase matures, the market approaches a moment of truth. The Composite Operator, having spent weeks or months quietly transferring ownership from weak hands to strong, must now answer one final question. Is the supply truly exhausted? The answer to that question is revealed in one of the most dramatic and psychologically deceptive events in all of market behavior, the spring, also known as the final shakeout. The spring is the third definitive proof of a true market bottom. It represents the decisive test of the trading range, a final probe beneath established support designed to verify whether any residual selling pressure remains. To the untrained eye, this move appears catastrophic. Price breaks below the well-defined support level that has held for months, seemingly destroying the bullish case. Fear explodes, headlines proclaim new lows, and traders once again panic. But for the Wyckoff student, this apparent breakdown is the ultimate opportunity. To understand the psychology behind the spring, one must think like the Composite Operator. His goal is not merely to buy stock cheaply, it is to own as much as possible without competition. Even after months of absorption, there often remain small pockets of supply. Traders who swore they would never sell again, but still hold latent fear, and speculators who place their stop-loss orders just beneath the trading range. The Composite Operator knows this, and he uses it to his advantage. By deliberately allowing prices to dip beneath support, he triggers a cascade of automatic selling. Stop orders are hit, margin positions are liquidated, and short sellers eagerly enter, believing that a new downtrend has begun. This final wave of selling flushes out the last remaining weak holders. In that moment of despair, when the market appears to be breaking down, the Composite Operator steps in with quiet but massive buying power, absorbing all remaining supply. This is the spring, a calculated act of deception that removes the last vestiges of resistance to a coming uptrend. From a structural perspective, several key characteristics distinguish a true spring from a genuine breakdown. Swift recovery. After the brief penetration below support, the price quickly rebounds back into the trading range, often closing the same day or week, well above the breakdown level. This indicates that demand was ready and waiting. Low volume on the break. Despite the dramatic price move, the volume during the spring is usually moderate or even lower than previous downswings. This shows that little genuine selling took place. Most of the activity came from forced liquidation and stop-loss triggers rather than new informed selling. Strong close. The most powerful confirmation is the price closing near the high of the bar or session, reflecting that professional demand decisively overwhelmed supply. When these conditions align, the spring serves as proof that the composite operator's absorption work is complete. The market is now free of meaningful supply, and the path upward lies open. From a psychological standpoint, the spring is designed to exploit emotion. It strikes when public confidence is weakest. Traders who endured months of range-bound frustration interpret the breakdown as final confirmation that the bear market remains intact. They capitulate at precisely the wrong moment. Wyckoff called this the point of maximum frustration and minimum risk. For those who recognize it, the spring is not a signal of danger, but of immense opportunity. The spring also serves another function. It shakes out not only the weak longs, but also the early professionals who entered too soon. The composite operator, ever patient, ensures that only the most disciplined participants, those aligned with the true rhythm of the market, remain positioned for the coming advance. Immediately following the spring, the market often produces a test, a smaller controlled dip back toward the spring low on lower volume. This test is critical. If the price holds above the spring level and volume remains subdued, it confirms that no significant supply has returned. This is the final confirmation that the market is ready for markup. At this point, subtle shifts begin to appear. Rallies start to expand with greater ease. Downward reactions become shallow and occur on declining volume. The public remains skeptical. They view these rallies as bear market bounces. But the Wyckoff trader recognizes that the character of the market has changed. The downtrend is no longer dominant. Demand is quietly taking control. This transitional zone marks the beginning of Phase C to Phase D in Wyckoff's schematic, the shift from testing to the first expression of strength. The spring represents the emotional bottom, while the coming sign of strength will reveal the technical bottom. It is essential to note that not all accumulations contain a dramatic spring. In some cases, the market tests support without breaking it. What matters is the principle, not the pattern. There must be a decisive test of supply followed by clear evidence that demand has regained control. When successful, the spring accomplishes what months of sideways action could not. It clears the field. Every weak hand has been forced out, every stop order triggered, every short position established. The market is now a vacuum of supply. Into that vacuum, demand can expand rapidly, producing the first strong upward move of the new bull market. In summary, the spring is a deliberate penetration of support engineered to trigger panic and remove remaining supply. The swift recovery and strong close confirm that professionals are buying heavily. The test validates that supply has been fully exhausted. This is the third definitive proof of a genuine market bottom, the moment when fear reaches its final extreme, only to be met by overwhelming professional demand. What follows next is the unmistakable signal of intent, the sign of strength, and the last point of support, the final confirmations that a major bull market is underway. After the decisive spring and its successful test, the market stands on the edge of transformation. The long period of fear, despair, and accumulation is ending. The composite operator, that silent strategic force, has finished his work of absorbing supply. The market is now structurally prepared for the next phase, the markup. In Wyckoff methodology, the transition from accumulation to advance is marked by two powerful and unmistakable proofs: the sign of strength, SOS, the show of intent, where the market finally reveals the presence of dominant demand; the last point of support, LPS, the final confirmation, where price and volume behavior validate the shift in control from sellers to buyers. Together, these events complete the proof sequence and announce the beginning of a major uptrend. Proof number 4, the sign of strength, the show of intent. The sign of strength is the first visible demonstration that the composite operator has taken full control of the market. After months of range-bound trading, tests, and deceptive shakeouts, the SOS emerges with energy and clarity. Prices break above the resistance line that has contained the accumulation range, doing so on decisively expanding volume and widening spreads. To the untrained observer, it appears sudden, as though the market has spontaneously come back to life. But the Wyckoff trader understands that nothing spontaneous has occurred. This breakout is the inevitable effect of the cause that has been built over weeks or months of absorption. The longer and deeper the base, the greater the potential energy behind this movement. The sign of strength tells us three critical things. Demand dominates supply. The breakout through resistance occurs effortlessly. Sellers who once controlled the market are now absent. Even as prices rise sharply, attempts to push them back down are met with immediate buying. Volume confirms the move. During the SOS, we observe large and expanding volume accompanying wide price spreads and strong closes near the highs. This is not speculative enthusiasm. It is professional demand asserting itself openly for the first time. Character of the market changes. The rhythm of price movement alters. Upward progress becomes fast and decisive, while downward reactions are brief and shallow. The market's personality has turned bullish. Wyckoff emphasized that the SOS is the first technical confirmation that accumulation has completed. It is the market's way of saying, the preparation is over, the advance has begun. However, professionals do not chase the initial surge. They understand that every strong advance must be tested to verify its stability. They wait for the reaction following the SOS, a temporary pullback that will define the next opportunity. Proof. R5. The last point of support. Final confirmation. After the sign of strength, the market often experiences a natural reaction as early traders take profits and late sellers attempt to re-enter. This pullback, the last point of support, LPS, is one of the most important moments in the entire Wyckoff cycle. The LPS typically occurs near the former resistance zone, which now acts as support. On the chart, it manifests as a controlled decline on decreasing volume and narrowing spreads, followed by a firm reversal upward. This behavior demonstrates that supply has not returned. Instead, the market is now being supported by professional demand. The LPS is where the composite operator often adds to his position. Having confirmed that the market structure is sound, he increases his commitment, knowing that risk is minimal and potential reward is immense. For the disciplined trader who has studied the preceding phases, the LPS offers a textbook entry point. The market has proven that the downtrend is over. Supply has been fully absorbed. Demand has shown itself through the SOS. And now, support is confirmed by the LPS. This combination of evidence forms the fifth and final proof of a completed market bottom. From this point forward, the path of least resistance is upward. Prices begin to climb in a series of higher highs and higher lows, marking the transition into the markup phase. Each rally demonstrates strength, each reaction finds support. The professionals are fully invested, while the public, still skeptical and scarred by the previous bear market, watches from the sidelines. Only later, as the uptrend matures and optimism returns, will the public begin to buy again, at much higher prices. But by then, the professionals who recognized the 5 proofs of the bottom are already deep in profit. Interpreting the combined evidence. Let us briefly review the sequence as a unified whole. Stopping action. Proof number 1. The selling climax halts the decline. Absorption. Proof number 2. The composite operator builds the cause, absorbing supply. Spring. Proof number 3. The final shakeout confirms supply exhaustion. Sign of strength. Proof number 4. The market reveals dominant demand. Last point of support. Proof number 5. The structure is validated. The bull market begins. Each proof builds upon the last. Together, they transform what appears to be chaos into a clear and logical process. For the professional Wyckoff trader, this framework is not theoretical. It is practical. It provides the tools to read the market as a living organism, guided by human emotion but governed by timeless laws of supply and demand. The sign of strength and the last point of support represent the culmination of this entire sequence. The moment when the professional ceases to anticipate and begins to act. They mark the threshold between preparation and profit. The sign of strength is the market's declaration that accumulation is complete and demand is in control. The last point of support is the professional's confirmation and opportunity for large-scale entry. Together they complete the 5 definitive proofs of a genuine market bottom. The professional now shifts from patient observer to active participant. The groundwork is done. The cause has been built. The path is clear. What follows is the markup phase, the reward for those who understood and trusted the process. The completion of the 5 definitive proofs marks not just the end of a market cycle, but the rebirth of opportunity. Yet for Richard D. Wyckoff, the lesson did not end with structure or strategy. It culminated in mindset. He understood that technical mastery alone could never make a trader successful. It was the mental discipline, the emotional equilibrium, and the philosophical detachment that separated the professional from the crowd. At this stage, after the last point of support, when the market begins to climb in earnest, the temptation is enormous. Prices rise, optimism returns, and traders who once swore off speculation rush back in, desperate to reclaim what they lost. But the professional, guided by Wyckoff's principles, acts without emotion. He does not chase, he does not celebrate. He executes his plan with calm precision, knowing that his advantage lies not in prediction but in preparation. The mindset of the professional Wyckoff taught that markets are human nature displayed in motion. Every chart is a mirror reflecting fear, greed, hope, and despair. To trade effectively, one must not merely study price and volume. One must study oneself. The professional speculator recognizes his own emotional impulses and refuses to let them dictate action. He understands that the crowd operates from emotion, while the composite operator operates from intention. The public reacts to news. The professional anticipates structure. The public buys because prices are rising. The professional buys because he knows that supply has been absorbed and demand is dominant. This detachment is not coldness, it is clarity. The professional views the market not as a battlefield of chance, but as an organized campaign of accumulation and distribution, guided by intelligent forces. He acts as a detective, gathering evidence from the tape and the chart, never assuming, always verifying. For him, the 5 proofs of the market bottom are not academic concepts. They are a mental framework that transforms chaos into comprehension. Each proof is a test, not only of the market structure but of his own patience. He does not demand instant gratification because he knows that real profits come to those who wait for confirmation. Patience, the core of professionalism. Among all of Wyckoff's teachings, none is more profound than the emphasis on patience. The composite operator does not rush. He builds his position quietly over time, testing, observing, and adjusting. The professional trader must do the same. Most traders lose not because they lack intelligence, but because they lack restraint. They act too soon, too often, or too emotionally. Wyckoff warned against this, writing, "The market rewards the man who acts in harmony with its rhythm and punishes the one who attempts to force it." The professional's rhythm is guided by the market's natural progression. Stopping action, absorption, the spring, the sign of strength, and the last point of support. He does not seek to outsmart the market, but to synchronize with it. Patience allows him to see what others miss: the subtle shifts in volume, the character of reactions, the strength of rallies. Each observation brings him closer to the truth of what the composite operator is doing. By the time the public notices, he is already positioned, and by the time the public acts, he is already taking profits. Discipline, the shield against emotion. Patience without discipline is wasted. Wyckoff insisted that every trader must have rules, clear, objective principles that govern behavior under pressure. The 5 proofs are not only analytical tools but disciplinary anchors. The selling climax teaches when to stop fearing. The absorption phase teaches when to observe quietly. The spring teaches when to trust logic over emotion. The sign of strength teaches when to act decisively. The last point of support teaches when to commit without hesitation. Each proof demands that the trader overcome a specific emotional weakness: panic, boredom, impatience, doubt, or greed. Mastery of Wyckoff's method is therefore mastery of one's own psychology. The professional speculator does not hope, he plans. He does not guess, he waits for evidence. He is not swayed by headlines or rumors because he knows that news follows price, not the other way around. The legacy of Richard D. Wyckoff. Wyckoff's teachings endure not because they describe patterns, but because they describe principles. Markets change, technology evolves, but human behavior remains constant. Fear and greed today are the same as they were a century ago. That is why Wyckoff's law of supply and demand, his law of cause and effect, and his law of effort versus result continue to govern price movement. To the professional trader, Wyckoff's legacy is more than a system. It is a philosophy of perception. It transforms the market from a place of chaos into a place of logic and rhythm. It reminds us that every movement, however violent or confusing, has a cause and leaves a footprint. The true Wyckoff student does not chase the market. He studies it until it speaks. He learns to think in probabilities, not certainties. He trains his mind to see the relationship between structure and psychology, between volume and motive, between human weakness and professional strategy. Conclusion. The calm after the storm. When all 5 proofs have unfolded and the market begins its upward journey, the professional remains composed. He knows that the real work is done long before the profit appears. His success is not the result of a lucky guess. It is the outcome of disciplined observation, emotional control, and unshakable patience. The Wyckoff trader understands that every bear market sows the seeds of a bull market, just as every bull market contains the seeds of its own end. His task is to read those cycles, not to fight them. So when fear reigns, he studies. When others sell, he observes. And when the evidence aligns, when all 5 proofs are confirmed, he acts with quiet confidence, knowing that he stands not with the crowd, but with the composite operator himself. This is the professional mindset. This is the Wyckoff legacy. And this is how one transforms market chaos into methodical opportunity. Time after time, cycle after cycle.